Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about one of my favourite topics, which is the benefit and power of playing the long game, as well as giving you a few examples. Now, hopefully most listeners have read my book Investopoly. In Investopoly, I outline 8 rules, and I suggest that if you follow those rules, they will help you, one, build wealth successfully, and number 2, and maybe most importantly, avoid making costly mistakes. And also what I say in the book is if you actually reflect on past successes and mistakes, and you relate those successes and mistakes back to those 8 rules will tell you what you did wrong or what you did right. And because they're evidence-based, they're rooted in sound fundamentals, basic logic, etc. So if you haven't yet read Investopoly, the book, I know it's a bit of shameless self-promotion, but certainly grab a copy. You can use the discount code BLOG, BLOG, of course. So if you go to the website, Pro Solution website, there's a page where I sell my books. You can buy a copy, $20, no postage, if you use the code BLOG. So hopefully that helps out. But anyway, let's get into this week's podcast, which is the number one rule in Investopoly is play the long game. And I think it's arguably the most important out of the 8 rules. That's why it's number one, the first one to talk about. Because the reason I say that is I think it's the mistake that most investors make. That is, they don't play the long game. And whilst the rule is really simple to understand, it's often very challenging to follow. So don't let its simplicity fool you into thinking you don't need to worry too much about it. So let's start off with a question. I'm going to give you 2 investment options. You can only pick one, and you need to think about, as you're listening to this, which one you would go for. So the first one is to invest in an index fund, in the share market, that will help you accumulate $500,000 of wealth over the next 10 years. So that's $500,000 more than what you've put into it. Or alternately, I'll give you a stock tip that will generate 50 grand of profit in the next 9 months. So have a think about those 2 options and think about which one you would go for. Remember, you can only pick one. Unfortunately, I think most investors are going to go for the stock tip option. And they might justify that decision by saying, look, I'll play the long game after I've banked a quick profit. Why would you not pursue and make 50 grand in 9 months? That's a really good outcome. And of course it is. And to many people, making a quick profit actually feels less risky than having to wait 10 plus years for a much, much larger gain. So there's 3 reasons why that short-term option is inferior. And it made me think deeply about this more recently when I came across a investment opportunity that was a 4 townhouse development. And it was projected to make somewhere between $460,000 and $550,000 in pre-tax profit, which equated to a return of 15 to 18%. And the development might take 2 to 3 years to actually execute. So I came across this opportunity. I'd assumed that those ranges in terms of those predicted returns are reasonable and conservative. And the development required about $3 million of capital, either borrowings or cash. So, of course, an alternative to that development strategy was, well, why don't you just go out and buy a $3 million investment property, for example, something that's really high quality, as I keep talking about, mostly land value, etc. And that was a better option for three reasons, which I'm going to outline now. So the first one is all about risk-adjusted returns. So risk really refers to whether your actual return will vary from your expected return. So how likely will it, or what's the probability of it varying from your expected return? Very low-risk investments produce very predictable returns. For example, a term deposit, you invest your money for 9 months, 12 months, whatever the term is, the return's guaranteed. I mean, it's guaranteed by the Australian government. So, that's a very low-risk investment, of course. Property development, well, lots of things can go right or wrong. So the return range or outcomes could vary between making a loss or making a massive profit. You can't compare two investment options without also comparing their inherent risk, because if you do that, you're going to make a mistake, and you're not going to be fairly rewarded for the risk that you're taking. So what I thought I'd do is I'd delve a little bit deeper in this podcast episode to compare those two options. A property development that's likely to generate heaps of profit, $500,000 of pre-tax profit, that's nothing to sneeze at. That's a pretty substantial sum of money. Or putting that $3 million into an investment-grade asset, which I'm not suggesting people do, by the way. I don't think it's a bad strategy, but I'm not suggesting people do. But just to make sure we're comparing apples with apples, I wanted to compare the sort of same value property and value proposition. So let's think about that long-term investment option then. Over very long periods of time, it's my view that a high-quality investment-grade house should produce a capital growth rate of at least 7 to 8% over very long periods of time. Quite often, and certainly in the last 30 years, good quality properties exceeded that. But 7 to 8% I think is a realistic expectation. Plus, of course, you're going to get some income after paying for expenses, property management, maintenance, etc., etc. You're probably going to get a rental yield of at least, say, 1%. So total return of 8 to 9%, including income and capital growth. And I've previously calculated in Investopoly, the book actually, that the Australian residential property has a historic volatility rate of 10%. So to put that in context, the share market's volatility rate's about 20%. Fixed interest and bonds are sort of 5 to 7%. So it gives you an idea of where in the risk scale residential property sits. So if we think about then property development, of course, there's lots of different risks or events that can occur that can change your investment return. So cost blowouts, like we're seeing obviously through COVID, the raw material costs have increased substantially for some developers. Failure to achieve your sales price, so the market can change in between starting the development or agreeing to the development and when your product is ready for sale. Adverse changes to planning rules, and the risks go on. So for the sake of this example, let's apply a volatility rate of 30%, which is 3 times higher than the long-term investment option, which is really based on historic data. And 50% more than the share market. So, and I think that's probably realistic where they sit in order. So a property development would be typically more risky than investing in passive shares over time. The Sharpe ratio is the generally accepted methodology to calculate risk-adjusted returns. And what it does is it looks at how much return do you get per unit of risk. And so I have calculated the development option, and a higher Sharpe ratio is better. And so I've calculated the development option has a Sharpe ratio of 0.48, and the long-term hold option has a Sharpe ratio of 0.56. So higher than the development option, which shows that the long-term option provides investors with a better return relative to risk. And so when you're thinking about investment options and investment strategies and so forth, it is most important to consider returns and risks at the same time. And it'll stop you or help you prevent, or at least make informed decisions and prevent you from perhaps making mistakes. The second reason why the long-term investment option is better is because of perpetual returns and compounding capital growth. The advantage of investing in an asset or asset class that is expected to generate very good returns over long periods of time is they benefit from that power of compounding capital growth. And I've got a link to a chart that I used last year that really demonstrates how that compounding capital growth really generates substantial wealth over time. The challenge with short-term investment options is that, of course, you must find another equally attractive investment opportunity as soon as that investment completes. So it's good, you might go and do a development, It takes 2 to 3 years. At the end of that 2 to 3 year period, you've got to find another development that's equally as attractive as the last one, and so on and so forth. And of course, that can be challenging, risky, and time consuming. And it's probably unlikely that you're going to find an endless amount of consistently profitable opportunities. And lastly, the third reason why the long-term investment option, and I'm going to go through the figures in a minute because I've done some projections, is better than the development, is that taxes erode wealth. So, of course, if you do a development, you sell the end product, you'll have to pay capital gains tax or income tax, whatever taxes you might need to pay when you do that. And the disadvantage of that, of course, is then you've got less money to reinvest over time. Whereas if you a long-term hold, you obviously don't pay the tax until if or when you sell that asset. And the delaying of the tax just allows you to reinvest your pre-tax return each year, and you benefit from that compounding capital growth. So taxes erode wealth and make sense. And by taking a very transactional approach to building wealth, you end up giving rise to higher taxes. So again, when you look at the headline numbers and think about, look, I'll do a development every 3 years, every 2 to 3 years, and make $500,000 in profit, it looks like a pretty attractive investment option. So what I did is drafted some projections, and I said, okay, if we did that every 3 years and we made that profit, and I applied that risk-adjusted return versus just buying a $3 million buy and hold property and really do nothing to it and just hold it for long term, what's the outcome? And I've included a chart there's a link in the show notes, of course, and blog on the website. The analysis is discounted back in today's dollars, so excluding the impact of inflation, and after all income and capital gains taxes as well in both scenarios. So I've treated them both in the same way. And the buy and hold strategy over a 30-year period produces 80% more wealth. 80% more wealth, over $3.2 million better off in today's dollars. And so I think that chart really eloquently proves the benefit of playing the long game and how tremendously powerful it is. Actually, when you see the chart, you'll see that it's pretty even over the first 10 years. The buy hold is, it's relatively even. And it really comes into its own when that compounding capital growth kicks in over, the second and third decade. And that's why I think it so eloquently demonstrates the power of playing the long game. Because after 10 years, you're neck and neck with each investment option. So you think you fool yourself into you thinking you made the right decision. Or even if you look in the earlier periods, in the first 2 or 3 years, you're actually better off with the development. So again, it fools you into believing you're on the right path. But it's not until, you're at year 15, 20, for example, that you really see the divergence of wealth. I mean, the one other thing that the chart doesn't take into account is the amount of time required from an investment perspective. So a buy and hold strategy on average, you're going to get years where things go wrong with the property and you end up spending a bit of time and energy sorting out. But there's also years where everything goes smoothly and you hardly think about the property at all. But really a buy and hold strategy is very hands-off. And maybe on average takes a few hours a year of your own personal time to deal with any matters or review, consider, talk to your financial planner, those sorts of things. Whereas a property development can be quite time intensive. You're project managing, dealing with inevitable changes or challenges, planning rules. You're looking at lots of different opportunities before you choose one, which requires you to do some due diligence and feasibility studies and so on. So property development's quite time consuming. The buy and hold strategy is completely at the other end of the scale and quite hands off. So why are people then attracted to short-term opportunities? Well, like I said previously, for some people, banking a quick profit seems less risky. Some people just don't want to wait 20 to 30 years to generate substantial wealth. Earning a quick profit helps them feel like they're making instant progress, I guess. Another driver is impatience. Young investors are more susceptible to this, I think, because they've got a smaller asset base. And so they really they've got a bit more urgency and they want to build their asset base really quickly. Whereas seasoned investors typically have already achieved a level of financial security, so they've already got a really sound and strong asset base. So they don't have the same sense of urgency and therefore have more patience to wait for longer term results. And ironically, as I've demonstrated here, that playing the long game is the most effective tool. So the impatience approach is actually obviously works against them. The other thing to think about too is, I give you a stock tip, make 50 grand over the next 9 months. It's a great outcome, no doubt. Like, of course, no one's going to say no to a $50,000 profit, but I don't want to be flagrant because 50 grand's a lot of money, but it's not going to change your life. And it's not going to change your retirement strategy either. However, making the decision to play the long game, investing in a long-term asset that's high quality, there's a high probability of delivering really good quality returns over very long periods of time, making that decision will change your life. So when you look at those short-term investment opportunities, that's the question. You can ask yourself, is it really going to change my life? Is it going to get me to where I want to go? So there's other 4, how do you play that long game? I thought of 4 sort of tips, I guess, to keep asking yourself or think about that'll help you play the long game. The first one is ask yourself, what can you invest in today that will maximize your investment returns over the next 10 plus years? I find 10 years is a really good time frame to think about because it's long enough to force you to focus solely on sound fundamentals. So drown out all the noise. In 10 years' time, will COVID matter? No, that you probably won't even be a thought in our mind. So we don't need to worry about the impacts of COVID over the next 12 months when making investment decisions. But also 10 years is short enough to still be able to conceptualize outcomes and results and where you might be. If you try and think in 20 or 30 year time periods, who knows what life looks like in 20 or 30 years' time? It's often too longer to really make sense. The second tip is resist the temptation to make a quick buck. But if you do want to pursue something that's short-term, make sure you can do it without the cost of compromising or delaying your long-term investment strategy. Look, I would say always resist the temptation, go play the long game all the time. But if you're going to do it, just make sure you're not doing it at a compromise of any other asset or strategy. The third tip is to appreciate that investments that have the fundamentals that will generate good returns over very long periods of time are far, far better than investments that generate a once-off profit. So if you're going to invest in anything, invest in those assets that will give you perpetual returns rather than a once-off return. And lastly, do your best to ignore all the short-term noise, which is, media, social media, spruikers, etc., etc. Most of it is designed to grab attention, sell advertising or sell product. It should not be used to inform investment decisions. Now, to wrap up, I could probably summarize it in one sentence, and that is that wealth transfers to the investors that have the most patience and the most discipline. Let me say that again. Most of the wealth transfers to the investors that have the most patience and discipline. Look, we're all tempted by short-term investment opportunities from time to time, and that's why it's important to regularly remind ourselves that short-term investments do not generate long-term value, and the best way to achieve financial independence is generating long-term value. It takes discipline to play the long game. Long-term investments require a fair amount of delayed gratification and patience. It's not always easy, but the evidence definitely demonstrates that it is the most successful path to building wealth. Playing the long game might not be particularly attractive or sexy, but it definitely works. Okay, guys, if you enjoy the podcast, please just a little reminder to leave a rating, a feedback rating, or even a comment. It'd be greatly appreciated. It certainly helps with the ranking of the podcast and helps people decide whether it's for them and whether they should invest some time listening. So if you enjoy it and you can do that, I'd greatly appreciate it. Until next week, bye for now.